next we will go through the legal principles of insurance contract. And now, as I mentioned, insurance is a contract. Okay, it's a policy. It's a contract between two parties. Now, who are the two parties? It is the insurer and the insured, which is the policy holder, as per Indian Contract Act of 1872. Now, what is the agreement between these two people? So, let us go one by one. Number one thing, the most important thing when it comes to contract is there should be an offer and there should be an acceptance. Okay, if someone is offering and the other person is not accepting, then it cannot be considered as a contract. Okay, so here if you look who is actually offering, it is the policy holder who is offering, because he is the proposer, and acceptance is made by the insurer. Okay, it's not whom we are offering, it's not we who are offering, it is actually the customer who is proposing his life. And for an contract to be valid, there should be some consideration, some benefit has to be there. Here premium is the benefit. Premium is the benefit by the policy holder. Okay, remember. So there are two benefits, consideration here. One is premium and another is indemnity. Indemnifying is nothing but indemnifying is nothing but compensation. Okay, indemnifying means it's nothing, compensation of loss is what you call as indemnifying. Okay, so that is nothing but insurance cover. Okay, is the insured amount is what we call as indemnity. Okay, so consideration by policyholder is premium and consideration by insurance company is the insured amount. An agreement, both parties have to agree to that, and it should be a free consent. See, most important thing. See, if it is forcible, then it will not become a legal contract. Okay, remember, insurance is not a wagering contract. Okay, insurance is not a wagering contract. Wagering is nothing but like betting. Okay, insurance is a legal contract, it's not a wagering contract, and it should be a free consent. That means it should not be done through some undue influence, or no one should force someone to do that. Okay, he has to accept from his mind, customer. No, it should not be done through coercion. Coercion means it's nothing but forcibly. See, for example, someone is forcing someone to sign on the document. That is through coercion. Okay, it should not be done like that. It's not applicable when it comes to life insurance. In fact, any insurance. Capacity, sound mind, and they should not be disqualified, and they should be a major. They should not be a minor, above 18. And legality, okay, of that insurance subject has a more importance there. Okay. Then, as we mentioned, it's a contract, so there are certain things which we have to abide, which is we call as first and most important principle is utmost good faith. See, both parties, even it's the insurer or the insured, company or the customer, they have to all disclose all facts. Okay, all material facts relating to subject matter of insurance. Okay, what is material facts? Material facts are nothing but, see, whenever the customer fills a proposal, the form which he submits is called as proposal form actually. Okay, the customer fills a form, the application form is called as proposal form. So the proposal form consists of all details about his personal details, family details, his hobbies, his occupation, his lifestyle, everything is there. Okay, so what is material information? Every information about his family history, his medical history, because that are certain diseases which are hereditary in nature, his financial, occupational detail, these are all called material facts. Okay, these are the facts which actually influences the decision of underwriter. Okay, these are the facts which can influence the decision of underwriter. Okay, this can influence the underwriter's decision. I told you underwriter, he is the person who decides to whom the policy has to be issued. He will decide. Okay, so that has to be done. Now, utmost good faith. So, suppose for example, if we are meeting a customer, do we know everything about him? No, we don't know anything about him. So he has to come forward and disclose all material facts. Now they will ask a question. When does this utmost good faith come into effect? This utmost good faith come into effect the moment the customer signs on the proposal form. Okay. See, for example, the proposal form, there is a declaration in the last. So the customer has to sign on it. Okay. The moment the customer signs on the proposal form, the principle of utmost good faith comes into effect. And there are situations where where you are going to violate this situation, where I will tell you, when you are not disclosing certain facts. Okay, when we are not disclosing certain facts, or when we are not concealment of facts. Concealment means that intentionally I am not sharing information. I know it, but I am not sharing it purposefully. Okay, that is concealment. Non-disclosure is that I am not disclosing certain informations. That's all. Okay, but concealment is purposefully. And then third one is misrepresentation. Now, misrepresentation can be done, can be of two ways. One can be innocently, that is by mistake. Okay, by mistake or by unknowingly I can give some information. That is innocent. Fraudulent is intentionally giving information. Intentionally giving information is what we call as this. This is by mistake. For example, my weight is I'm giving just a typical example. My weight is 56, but I am unfortunately I am telling that, oh, my it is 65. Okay, by mistake I am telling this. You can take it. Fraudulent is purposefully. See, have you undergone a surgery? No, I am telling that no, I have not undergone a surgery. Okay, similarly, intentionally they are asking, have you taken any other life insurance? I am telling no, I have not taken any life insurance. Not, I am concealing the fact. Okay, similarly, so this is the first principle. Utmost good faith is the first principle. Second principle is insurable interest. Now, insurable interest can be dealt in your question at times called as insurability. Okay, this can be told as insurability in your question also. Insurability is nothing but see, under what circumstances can I execute insurance? What are the circumstances under which I can execute insurance? See, for example, there is a customer. Okay, there is a man. Now, he wants to take insurance. What all things he can insure? One, he can insure his assets. Okay, he can insure his assets. He can take on his own self. He can do it. There is no restriction. Assets he can do it. Then what he can do is on minor children. Okay, minor children he can have it, not on major, minor. Then what he can do is his wife. So suppose you have a person, an individual can, where are the situations where you can take insurance? You can take insurance on your assets. Okay, because you have insurability. Self is okay. Wife, similarly, husband, wife, they can take both. Minor children. Okay, see, how do we look at insurability? Insurability means, see, if some risk happens to to a particular asset, okay, then there should be two things. Okay, one, there should be an economic loss, and two, there should be some legal relationship. Okay, See, there is some belonging to you. So whenever there is a loss happens, there should be two things. See, for example, suppose your friend has a car. Now, can we insure it? No. Why? Because if something happens to that vehicle, there is no economic loss for me. Similarly, I am not the legal owner of that particular property. Okay, so it's not possible. Okay, whereas I can take insurance in my name of my parent. Parent is applicable when it comes to health insurance. You can take, but which you can never do in your life is you cannot take an insurance in the name of your friend. You cannot do that. Similarly, you cannot take insurance in the name of your brother, sister, uncle, grandparent, or grandchild. No, it's not permitted. Only is self, husband, wife, minor children are assets on your assets. Now, when will the company look into this? Company will look into this only at the time of commencement. Okay. Whenever I go and take policy in life insurance, they will look into this at the time of commencement and at the time of reinstatement. Okay, commencement is nothing but start of policy. So, for example, when I'm going to take life insurance, they in my name of my wife. Okay, they will ask me, okay, what is the relationship? Can I have? Do I have any insurable interest? Yes, I have insurable interest. Why? Because there is an economic loss and there is a legal relationship. Okay, that they will look at the type of startup policy and also at the time of reinstatement. Okay, reinstatement is meant renewal of lapse policy. Whenever my policy lapses, when does the policy lapse? If I don't pay premium, the policy lapse. So when I go back and reinstate that policy or revive that policy, again they will ask the same question. Okay, but they will not ask that question at the time of claim. In life insurance, claim not applicable, insurable interest. Whereas in non-life, it is applicable both at the start and at the claim. See, for example, if you have a car, when you are going to insure that, they will ask for the ownership. Okay. Similarly, when you go for the claim, also they will ask for the ownership of that. Okay, that is what we call as insurable interest in non-life. So both you have to that, but in life, no, only at the time of taking policy, not at the time of claim. Because see, for example, if I get married, I have taken a policy in the name of wife. Now, there can be a situation that both can be separated. Okay, and the wife can get, both are separated and they are living in a separate life. Even now, when if something happens to a spouse, wife, the husband can still go and claim the money. The company will not ask. Okay, that is in life insurance. Where in non-life, they will ask both. Now, marine insurance, it's only at the time of claim. Okay, I will give you a situation. Marine insurance means, see, it's nothing but it's related to export. So what happens there is, whenever risk happens, they will check in which area or in which horizon as the risk has happened, whether it has happened in the area of an importer or an exporter. Okay, that is one number. Then proximate clause. Proximate is nothing but it's the main reason behind various activities. What is the main reason of insurance happening? Okay, see, the subject matter of insurance we call as, okay, what is the risk which is actually insured? We have to analyze the exact risk what has happened. Based on that only the claim will be given, but it can happen with a series of situations. For example, I will give you a small scenario. So I have taken accidental insurance. Okay, accidental insurance means if I die because of some accident, I get a benefit. Now assume a person is riding on a bike, on a horse. He fell into a pool of water. Okay, he fell into a pool of water. Because of that, he has been diagnosed with pneumonia, and death happens. Now, actually, what is the reason of death? The reason for death is because of pneumonia, he has died. Now, what is the cause for this pneumonia? Because he has fallen from the horse. He fell from the horse and he fell in the pool of water. Because of that, pneumonia has been diagnosed. He has been infected with pneumonia and death happens. Now what is the proximate clause? The proximate clause is that he has fallen from the horse. So insurance company will go back and look into this. What is the exact cause? What is the actual uh, event which has happened? And based on that only they will process the claim. That is proximate clause. Free look period is nothing but once the customer receives the policy document in hand. Okay. Once you get your policy document in hand, you are given 15 days time to cancel the policy. That is free look. Okay, 15 days. So you can cancel the policy within 15 days. So what will happen? The company will refund. They will not refund the entire amount. They will refund a particular amount. Okay, they will deduct certain charges and balance amount can be refunded. That is. Now indemnity. Indemnity means it's nothing but compensation of loss. Okay, that is nothing but it means who suffers a loss is compensated so as to put him or her in the same financial position as before. I'll give you a small situation. You have a car worth 5 lakhs. Okay, this is the value of the car. Now the car meets with an accident and your loss is 2 lakhs. Now even if your insured amount is 5 lakhs, the company amount is 5 lakhs, the company will pay you only 2 lakhs. Okay, this is what we call as principle of indemnity. So what is the intention? Is nothing but to ensure that to reinstate the asset as it was before. Okay, the loss happened. So only your loss is only 2 lakhs. So they will compensate only 2 lakhs. And this is applicable only for non-life. Remember, this is applicable only for non-life insurance. It's not applicable for life insurance. Life insurance, this concept is not applicable. Okay, principle of indemnity is not applicable for life insurance. And then you have is subrogation. Subrogation is nothing but it's a process where the company recovers the claim amount. Okay, see, in India there is only one insurance which is mandatory. You know that is third party insurance. Am I right? Third party vehicle insurance. Third party vehicle insurance is mandatory in India. There is no question about against this. It's as per government, it is mandatory. Okay, so here what happens, subrogation means, suppose if I'm riding my car and I go and hit a person and something happens to him, so then what will happen, I have to pay him compensation. So what the insurance company will do, they will pay the compensation. Why? Because since I have the third party is nothing but compensating the third persons because of my fault. Okay, now if I have done this intentionally or if this has happened because of some negligence, there is a process for the company to recover the money from me. Okay, see, normally what happens is I am the customer. Remember, I am the customer. Okay, now due to negligence or something, I hit a person. Okay, I hit a person and he dies or something happens to him. Okay, so what happens, the insurance company will pay him the amount. The company will pay him the amount because I have taken a third party insurance. Okay, company will pay the amount, and if I have done this through negligence, the company has the provision to collect the money from my hand. Okay, that is what you call a subrogation. Okay, option, this company has to collect the money from the customer. Okay, In this, most of the cases we have discussed already. Risk, there are various types of risk, which goes living too long, living with a disability. Okay, dying too early is a risk. Living too long is a risk. Living with disabilities are the different types of risks. Indemnity, I have mentioned, is compensation of loss. That is, even if I have an insurance coverage of 5 lakhs, but if my loss is only 2 lakhs, company will pay me only 2 lakhs. That is indemnity, compensating the loss. Premium, principle of risk, level premium is nothing but the premium which I pay throughout the policy term is going to be the same premium. Okay, see, when I start paying 10,000 rupees in the beginning, that will be the same premium I will pay till the end of the policy term. Okay, whatever the product is, whatever happens in the situation, the premium will not increase or decrease. Okay, remember, in insurance the premium will never increase or decrease. Once you have taken a policy, that is the premium which is going to continue. Then principle of risk pooling, this is what I called as before we discussed. Okay, mutuality. Okay, because as I mentioned earlier, car and an aeroplane, the money which is collected for car will be used only for the car. It cannot be used for aeroplane because they both have different risk in their category.